Welcome to This Explainer. Today, we're going to put on our investment analyst hats and look directly at the economic dashboard. Look, there is a lot of noise out there right now, but our goal here is pretty simple. We want to cut through all that chatter, look at the actual data, and see if the warning signs of a recession are already here. I like to think of the economy like a massive, intricate car engine. We really need to read the gauges before smoke starts pouring out from under the hood, right?
You know, the funny thing is, most people only realize a recession is happening after it's already well underway. By the time the major headlines actually confirm it, the economy has usually been slowing down for months. Waiting for the evening news to tell you we're in a recession is literally like driving a car down the highway while only looking in the rearview mirror. So our core question today isn't necessarily, are we in a recession right this very second? The far more important question is, are the warning signs flashing red on our dashboard today?
All right, let's just quickly fly through our roadmap for today. We're covering the anatomy of a recession, global versus U.S. growth, tracking the economic signals, the inverted yield curve, soft versus hard landings, and finally, navigating the cycle. Okay, Section 1, Anatomy of a Recession. Let's set our baseline. A recession isn't just one bad week in the stock market or a single negative GDP print. It is a significant, broad slowdown in economic activity across the board. Think of it as a systemic loss of momentum that just kind of spreads its way through various sectors of the economy.
It really is a classic domino effect. As analysts, we watch for this exact sequence to play out. When everyday consumer spending drops, businesses obviously see lower demand. Because demand is down, those businesses pull back. They invest less. And well, when businesses aren't investing or growing, job growth naturally slows down, or we even start seeing outright job losses. It's that tight interconnectedness of all these factors that truly defines a recessionary cycle.
Moving on to Section 2, Global versus U.S. growth. Let's check the macro weather forecast. The contrast here is actually pretty striking. U.S. GDP growth has slowed down to right around the 2% mark, which is a noticeable step down from the much stronger levels we've seen in previous years. Meanwhile, global growth is also moderating, sitting at a forecast of around 3%, but definitely with increasing downside risks. As analysts, we know that seeing slowing growth across both domestic and international markets is very often one of the earliest signs that the global economic engine is starting to lose some serious momentum.
Section 3, Tracking the economic signals. Let's look at the pressures currently in the system. Our very first major dial on the dashboard is inflation. Right now, it is just stubbornly hovering around 3 to 4% in the US. Now, sure, we can all agree this is way better than the incredibly painful peak levels we lived through recently, but it's still sitting uncomfortably above those long-term targets central banks want to see. The engine is just still running a little bit too hot.
And here's where causality is absolutely crucial. To control that elevated inflation, to essentially cool the engine down, central banks are forced to step on the brakes. They do this by keeping financial conditions tight and interest rates relatively high. And what happens when rates are high? Well, borrowing becomes way more expensive. Because it's expensive, businesses decide, hey, let's delay that expansion. And everyday consumers start rethinking their spending. Step by step, this intentionally and gradually pulls down overall economic activity.
Section 4. The inverted yield curve. This is the famous red flag you always hear about. Simply put, an inverted yield curve happens when short-term interest rates are actually paying out higher than long-term rates. Think about how bizarre that is for a second. Normally, if you lock your cash away for 10 years, you demand a higher return for taking on that time risk, right? But currently, the entire system is completely flipped upside down, and it has been inverted for a pretty extended period now. Putting my objective analyst hat on, I have to point out that historically this exact type of inversion preceded both the dot-com bust and the 2008 financial crisis. It basically tells us that the bond market is betting heavy that growth and inflation are going to slow down significantly in the near future, which will eventually force central banks to cut those rates to save the economy. Checking our next set of dashboard dials, we have to look at jobs. Now remember, labor markets are almost always the very last thing to weaken, not the first. Currently, U.S. unemployment is sitting at a historically healthy 4%. But if you look under the hood, early softening is absolutely visible. Hiring is slowing, total job openings are steadily ticking down, and wage growth is flattening out. The job market isn't breaking by any means, but it is for sure bending. Meanwhile, everyday consumer behavior is telling a super fascinating, albeit cautious story. Spending is technically holding up, which is what's keeping the economy moving right now. But look closely at what is actually fueling it. Precariously, it's being propped up by people draining their personal savings and swiping their credit cards more often. This is a vital takeaway. You can only run the engine on credit and dwindling savings for so long. Once those wells run dry, consumer spending could drop off a cliff quite suddenly.
Section 5. Soft versus hard landing. The two paths ahead.
Right now, if we step back and synthesize all this data, our economic engine is showing what we formally call late cycle behavior. Translation? The engine is tired. It's losing forward momentum, and the downside risks are definitely climbing. However, and actually this is a really crucial distinction to make, we haven't hit a full-blown contraction yet. We are absolutely slowing down, but we haven't stopped.
Because we haven't fully contracted, there are still two very distinct paths forward on our dashboard. Scenario 1 is the soft landing. In this dream scenario, the central bank's braking maneuver works flawlessly. The economy slows down just enough to kill inflation, growth stabilizes, and we dodge a recession completely. Scenario 2 is the hard landing. In this case, those high interest rates act like slamming the brakes way too hard. Demand plummets, businesses aggressively slash costs, unemployment spikes, and boom, the economy officially contracts into a recession. At this exact stage in the cycle, both of these scenarios remain entirely on the table.
Finally, Section 6, Navigating the Cycle. How do we process all this?
Look, if this current slowdown continues, whether it ends up being a soft or hard landing, here is the real-world impact you can expect. Everyday workers are going to see slower job growth and smaller wage bumps, businesses are going to face tighter profit margins and become way more cautious with their cash, and everyday households expect increased financial pressure, leading families to definitely cut back on vacations, dining out, and other discretionary spending. To protect your personal finances right now, the smart move is to build up your emergency cash reserves and aggressively tackle any high variable interest debt before a potential contraction hits. That is exactly how this high-level macroeconomic data hits your kitchen table.
But hey, it is so incredibly important to keep some perspective here. Not every single slowdown turns into a devastating 2008-style recession, and note two recessions look exactly the same. The ultimate takeaway from our deep dive today is that economic cycles, these long periods of growth followed inevitably by periods of slowdown, are completely 100% normal. Historically, while contractions can definitely be painful in the short term, markets and economies inherently recover and grow over time. The trick is to not react emotionally, because when you actually understand the system and the data driving it, you are far less likely to be surprised or panicked when things shift.
So, as we wrap up this explainer, I want to leave you with one final provocative question to chew on. Now that you've looked under the hood and seen the raw underlying data for yourself, are you going to actively read the economic signals, or are you just going to sit back and wait for the headlines to tell you what already happened?
Please remember that this explainer is strictly for educational purposes to help you decipher the economic data and does not constitute financial advice. Keep your eyes on that dashboard, keep learning, and I'll see you next time.